Homies, welcome to a very special interview of the week. This week we have with us Scoopy Trooples of Alchemix. How you going, Scoopy?
Oh, I'm doing great. How are you guys doing?
I'm doing very, very well.
With me, as always, is Dropkick Darren, who was on a little bit of a break, but now we have him back, and I'm very glad because it means that I don't have to spend as much time managing people.
I'm back. Apparently, I only manage no podcasting here.
Hey,
but it's good to be back.
Voice. All right.
I think, why don't we kick things off before we get into kind of like a bit of an intro of yourself for some of the homies who aren't familiar. What's one thing you like and dislike about podcasts in general?
I mean, I love like podcasts because the long form format really lets you go in depth with creators and hosts, and you can, get a lot more from that conversation, a lot more nuance than you can, from like, some short packaged news bite or other traditional media coverage. The only thing I don't like about podcasts really is that there's just too many of them now. Like a couple of years ago in the space, there's like maybe like 4 or 5 good podcasts, and now like there's just so many. I don't have enough time to get all the alpha.
Yeah, I always try and listen to the Goodwill Yunting, but like it's so difficult to like just find time to fit things in when you're like actually working in the space. I don't even I used to listen to Sassel every day, the Daily Gway, yeah, but like I just don't have any time.
I listen on like my walks and stuff like that, but that's like an hour, maybe a little bit more than that a day. So it's like, hey, I can get one podcast in a day when there's like 30 coming out. So oh well, what are you gonna do? What's
your like top podcast you like?
Probably for like deep dives and technical things about like upcoming exciting projects. I like Epicenter podcast the most.
Yeah, they had Zeus on like last week, I think.
Yeah, they've been OGs doing podcasts since I think like 2015, like way back. That's how I learned about like MakerDAO and DeFi before DeFi was even called like DeFi and stuff. So
Yeah, Mariano's interview. That was like my first podcast on like DeFi. I was like, holy shit, people are building this stuff. I had no idia.
Damn, man, I'm too young for that shit. All right, we got to get into.
We
got to get into your like intro that's not a regurgitated one, as in like something that's. How would you describe yourself to like in a different way?
I guess I've told my origin story enough, but like. On Twitter, like I guess the trend last week was talking about like, oh, who here came from like, a lower middle class family and worked their way up and stuff like that. And I mean, I can say that about myself. I came from a lower middle class family, at times was on free lunch growing up, had to finance like 75% of my college with debt. And the rest was with like grants and scholarships and stuff. And then, just kind of winging it through life and just, not really sure what I want to do, kind of stumbled down some different career paths. I wasn't really making any name for myself. I was just kind of getting by. And then finally I got into crypto in 2016, and that afforded me the opportunity to get away from the current career I was in and move into doing blockchain stuff. And so in 2018, I quit my job and started learning how to code full time. And 2 years later, I was brought in to be one of the founders of Alchemix because they needed somebody to code up the front end. And that became what I did. And I kind of grew into my role in in Alchemix.
Was that through eGirl? Is that?
eGirl just kind of happened, like not related to Alchemix at all. It was just, my Twitter was starting to get like growing. I started getting some different friends and people I would like post with a lot on Twitter. And CL made a meme showing like some like marketing page of a website, and it had like, the big VCs, 3 Arrows, Paradigm, and all the other big ones. And next to it, it was like just like this picture of like this anime girl with an Ahigawa face, and it said eGirl Capital, and it's like, would you ape this project? And then Muni and me and like a few other people were just like laughing at this, like, let's totally make eGirl Capital. And we did. And eGirl was part of Alchemix's launch. They did help us source our initial liquidity for our sushi swap listing. But like, yeah, I think I've talked about that where they, all the ETH that was raised for that just went straight to the pool, essentially. Yeah, and not for us team. So,
yep. So I think maybe I'll just quickly cover that Scoopy is one of the co-founders of Alchemix, which is a protocol. I mean, I would describe it as like centered around sort of borrowing against interest-bearing assets with non-liquidatable loans that pay themselves off over time. I don't know if you'd like that. There's the V1, but we've got like V2 coming out hopefully sometime this month. Is that still how you would describe it, knowing what's in V2?
Yeah, the idea is more or less the same as V1. It's just bigger and better in just about every single way possible. Whereas V1 for ALUSD, you can only put in DAI, and that DAI only goes into Yearn strategies. And then same with ALETH, you can only put in ETH, and that goes into Yearn. That's going to open up a lot in V2. So multi-collateral is one of the new features that's going to go into it. We're going to be targeting DAI, USDC, and USDT at first, but we are open and eager to get other decentralized stablecoins in there as well. And now we're also going to have multi-strategy. So at launch, it's going to still be Yearn, but already underway are audits for C tokens and A tokens. So that's going to allow us to plug into Aave and Compound, but any other token that also follows, that format. So Rary Fuse is one that has the same architecture as Compound tokens, for example. And something like a wrap stake ETH is also something that follows sort of more of like the A token. So like when it's positively rebasing ones, but now there's we have a wrapper that's going to be able to handle assets like that. And coincidentally, that same wrapper could also handle something like a Geo.
There's one big protocol that's missing that I think you might see.
But wait, there's more. Before we get there. So the cool thing about this is, like, let's say you put in, 10% in DAI Yearn and 20% in Aave USDC, and then you have the rest in, like, let's, say, Rary USDT or something like that. It's just some random, distribution of where you could put it, like different collaterals and different strategies. That all comes together to make a like composite deposit in the system. So you just take all the balances of everything that you deposited, and that becomes your basis for how much you can borrow off of it. So you don't have to separate it per vault that you're in and have everything be segregated. It'll be, done that way. And you have the ability to deposit the like kind of like the canonical naked token like DAI or the yield bearing version. So it'd be like, you can put in YV DAI, C DAI, A DAI, whatever, and you can put it in that way. Either one.
So then it's still the sort of 50% loan you can take in the ALUSD?
Governance is having a discussion about that, about raising the loan to value ratios. So ultimately, it'll be up to the community to decide what it's going to be. I would probably caution against anything more than like a 66%, or like a 2/3 loan to value ratio. And the reason is that if you can take out more and more from your loan, then basically you can go through a loop where you would borrow ALUSD, sell it for one of the collateral tokens, put that in Alchemix, borrow more ALUSD, and so forth. And at like a 66% loan to value, you can get up to like 3x leverage essentially on your stablecoin farming. But anything more than that can start to put too much leverage and too much, into the system, and at the detriment of the pay and future users of Alchemix. So I think, having it be 90% and allowing for 10x leverage, might be great for the degens, but it also might, cause some problems for Alchemix.
Yeah. I know there's a protocol that we all know that did it with some treasury assets, like looping it some absurd amount of times. It was like 10 or 11 or something. Were you watching kind of the degen box?
Yes, I was watching, and holding my breath at the same time. I think like looping stablecoins isn't terribly a risky thing, but when you're involving cross-chain bridges into the actual app, it just opens up a huge attack surface. Imagine what happened to Wormhole happened, to UST in that scenario. Like Like, I don't know if Do Kwon has enough money to bail everybody out. And honestly, like the degen box thing was like really bad for UST and Terra, because like it just like essentially the Wonderland Treasury with like their, you know, through their strategy, they were like just draining the anchor fund from their yield, like, and stuff like that. So yeah, funds are Sifu.
Yeah.
Oh, we're gonna. I think we'll touch on some funds Sifu at some point later in this. But for people, for a little bit of context, talking about the Jump Capital wormhole stuff, like what the hell's a wormhole? The other day there was a exploit close to 300 mil or close thereabouts.
120,000 ETH.
Was it Jump Capital specifically, or?
Yeah, Jump came out and said that they were doing it, but I'm sure that there's probably some FTX involvement as well.
Yes, but VCs bailed out everybody, essentially. So that's an interesting narrative. I don't know where that will go moving forward. One thing I do want to touch on and talk about the strategies. How does Alchemix evaluate risk for some of the strategies that you guys partake in for what's deposited, for example?
Yeah, so in V1, we didn't really have to worry about risk too much. You know, Yearn is kind of like, you know, one of those gold standards of crypto. Their team is amazing. You know, and they follow a lot of best practices and go through multiple security audits and stuff like that. So we felt very comfortable with Yearn. With other protocols going forward, we're going to try to open up and sort of be like the top layer of DeFi. You know, we have like a Curve LP token strategy in the works as well. So that'll allow us to plug into Convex and things like that. And anybody who builds on top of Convex, you know, type of thing. So that's something that's really cool. But like, you know, how we select yield aggregators is, you know, just a lot of due diligence, researching them, researching the team, how long they've been on the market, if they've had any accusations thrown at them, things like that. Really just making sure that the teams behind these, you know, these products are really good and really solid and long-term oriented. And then the other is, you know, having our own, you know, team go through the contracts and try to look for any potential exploits or vulnerabilities. And then from there, you know, we can make a recommendation that we can add the strategy, and it'll be up to the governance to, you know, ratify it. We have some safeguards in our V2 that can allow us to take on some risk. And there's two main components. One is deposit limits. So we can cap the amount of deposits that can go to any one individual strategy. So like if people are really uncomfortable with, you know, something like, I don't know, empty set dollar going into Alchemix or something like that, it'd be like, okay, there can only be 100,000 of these deposited. Because the system thinks that whatever goes in is worth $1. And that's one assumption that it makes. So we have this deposit cap, you know, something like LUSD. Like I love LUSD. I think that they're, you know, it's a very pure, very decentralized protocol. Liquidity, but their peg is, you know, a little bit volatile, I would say. Like I checked a couple of days ago and I was at $1.03, and I checked like a couple of months ago and I was at like 97 or 98 cents. So it oscillates at that $1 mark, but it doesn't, you know, it's not like locked onto it like some of the other stable coins are. And so what would happen if we added LUSD and it became like a big share of the market for us? ALUSD would start taking on its characteristics and start mirroring its peg. So that's something that we have to, like, you know, decide, like, okay, we want to have LUSD, but we need to find out how much is the max that we can really accept into the system, where, it's 2% variance up and down from its peg, can be so small that would only really mean like a 0.01% variance for ALUSD, something like that. So we have to balance that. And the other one that we have, the other safeguard we have, helps the protocol in case there is a sudden depegging of an asset. And if oracles, because oracles sometimes have like a 15, 20 minute lag on them. And in that lag time, a lot of damage can happen. And so what this would do is it's called a convertible cap. So in Alchemix right now, you can repay your loan using ALUSD or DAI, and unlimited amount of either one. So if you had like $1 million debt, you could repay that with DAI, like right now. But with V2, we have something called a convertible cap, which allows the system to only repay debt that's not used with ALUSD. So if you want to repay your debt in DAI, USDT, USDC, etc., there's a certain cap daily for how much can actually be repaid with the collateral asset. And that way, like, let's say, some stable coin goes to, 20 cents or something like that. Theoretically, somebody could put in Alchemix. Alchemix will recognize it as $1. Then they can mint, however much they can mint off of it, and then use that to arb it back and buy it more and do it again and again. And they could do a lot of damage. This convertible cap will mitigate it and then allow, the other defense mechanisms to step in once, threat detection has been noticed.
So is it going to be like there is like the Transmuter, which you've been sort of filling up with some extra dye through OP? Is that what's been happening?
So the Transmuter is fed in 3 different ways for Alchemix. One way is through debt repayments when we harvest yield from the vaults that we're in. So when that happens, that yield is used to pay off someone's debt, and then that goes into the Transmuter as a peg backstop. Same thing if somebody repays their debt in collateral tokens of DAI, that would go straight into the Transmuter as backing. And somebody can also liquidate their position, their collateral, to repay debt. And lastly, we do Olympus Pro, where we basically do that last one where we liquidate it. So we get the DAI from Olympus Pro, put it into Alchemix, mint ALUSD, then liquidate our collateral. So then it ends up being, if we had like 1 million DAI, it would be 500,000 ALUSD, 500,000 DAI at that point. And then we put that 500,000 DAI and ALUSD into the curve pool. But in this process, we added $1 million in liquidity, but we also added 500,000 DAI to the backstop in the Transmuter.
Yep. So that's kind of...
So it's like a multiplier effect that we get through Olympus Pro in doing it that way.
Very cool.
Interesting. One question is like, for the convertible caps, is that isolated to like specific asset, or is that spread across all deposits?
That's isolated to specific assets. So we can say there's like, 5 million convertible cap for USDT or something like that, for example, we could do that. So we can limit the damage to any one stable coin.
And you guys are doing some stuff with Tokemak and joining the Curve War? I'm not sure of you. Is that public?
Yeah, I wanted to get into this.
Yes, we have been joining the Curve War, very much so. We're up to 170,000 CVX. We initially were in kind of early in getting into the CVX party, but then we kind of took our foot off the gas. Back in September, we took a loan through Abracadabra, because ALCX is one of the collateral types there. And and with that loan, we ended up buying like 70,000 CVX at the time. And then once we started doing like kind of protocol owned liquidity, we've been farming in convex with that. And we also have Olympus Pro going on for getting CVX. And so since then, we've added about 100,000 CVX, and we're adding around 20 to 30,000 every 2 weeks at the current pace. So we're definitely trying to step it up.
Yeah, you guys are at, I think, roughly almost $2.5 million in convex solely through OP, which is awesome. And I think I just wanted to touch on OP for a second, because you guys were the OP pilot partners, the trendsetters, one of the first to do it. I kind of want you guys to give us your opinion on what it was like to kind of make that decision to transition from kind of managing emissions within the protocol, and then be like, okay, we're going to trial this and see what happens. As of right now, I think Alchemix owns at least 6% of its ALCX ETH LP, which is awesome. So maybe you can kind of run us through that, what that was like when you first made that decision, and also like how you're finding the program right now, because you're bonding 5 assets at the moment, which is awesome.
Yeah, so we I think it was like in August, I was like really like looking at the charts and the math and looking at kind of DeFi as a whole. And I was kind of realizing at the time, like that, liquidity mining is, kind of one of those like necessary evils to like kind of bootstrap and jumpstart a protocol. But in the long run, it becomes very injurious to the token holders, just because of the constant dilution, and it attracts a lot of like mercenary farmers. And just looking at every single DeFi chart with liquidity mining, they all tell the exact same, story. initial hype, lots of price action, and then a slow but gradual decline from there. It's like every single protocol with liquidity mining has the exact same chart, it looks like. And I was like wondering, and I knew Alchemix that our emissions are, they're tapering down every single week for 3 years until we hit our tail inflationary budget. And I was trying to run the numbers, like if Alchemix price is the same as it is now, by the time we're at tail emissions, we can really only support, maybe a third of our current liquidity. And we wouldn't be dead or anything like that, but we'd become very much less relevant as a result. And I was kind of like racking my brain about how, we could flip the tables on this. And at the time I was just dabbling in Ohm just a little bit. I had few $1,000s worth of Ohm that I bought early on because one of my friends said, I just bought $1,000 stable coin. Ask me anything. And I was like, okay, what's going on here? So I just threw a little bit in there just as an experiment and see what was going on. And as a result, I was paying attention to Ohm and Olympus, and I saw how you all were able to acquire so much liquidity, and having one of the deepest pools in sushi without having a pool too. And it kind of got my gears spinning in my head. And I was like, well, why can't Alchemix do this? And so I started like peeking at your code, like, well, we could just fork Olympus DAO and do this. But it's like, it's also going to be a lot of work to do that and understand new systems, and, probably piss them off. And then I just I think I approached Jaws. I'm not sure who I approached. I was like, hey, can we do, can you guys offer your bonding services to other protocols? And it sort of seemed like one of those moments where it's like perfect timing, because that idea started being floated inside Olympus DAO before we reached out. So it was just sort of like, already in your minds, and then you had somebody reach out to want to do it. And so that's how we got hooked up.
What an origin story.
Are you still doing liquidity mining?
Yes, we are. Because, especially with Al ETH and Al USD, those pools are quite massive, a lot bigger than even the ALCX ETH pool, much, much bigger. So in order to retain that liquidity and, make Alchemix actually useful for people, we have to, have some good liquidity for the system. So we transitioned our liquidity mining for Al USD and Al ETH into Convex Vodium, using the bribing platform.
Very cool. Yes.
And that's been nice. We've been able, between Olympus Pro and starting to acquire a Pool 2 liquidity and also doing Convex bribes and acquiring Convex, we've been able to cut down our emissions across the board for all of our pools, in addition to having disinflationary rewards that go down every single week. And for example, our Pool 2 was at one point getting 50% of all emissions, and now it's getting 20%. And we've retained still a majority of the liquidity.
So are you guys planning to go cross-chain or to a layer 2? And I also wanted to ask if there's plans for ALCX to have, it's currently just a governance token, and I don't know if there's sort of fee capture in there as well, but is there other utility planned for it?
Yeah, so we are going to do multi-chain, because cross-chain implies that an app is actually doing things between chains. These would be separate Alchemix instances on different chains. And you'd be able to swap Al USD back and forth between chains and things like that, or any of the Al assets. But they would be their own self-contained thing. And so they would get their yield from the chain that they're on, for example, instead of ferrying it over to another chain, doing yield farming over there, then bringing it back. I think that's, too risky. I think the cat's already out of the bag. We're planning a Phantom initial deployment as our first, sidechain that we're going to go on.
Makes sense with Yearn there. Yep.
Yeah, exactly. That was the deciding factor. And we want to do Arbitrum as well. We're just waiting on Yearn to get there, or our A token code to get audited. And that would allow us. Yeah. So as far as the DAO goes and Alchemix token, I think we're done our spec for our DAO, and we started developing the first piece of it. So first thing we're going to do is have a X sushi style token. And That'll be like XALCX, name TBD. I don't know exactly what the prefix is going to be, but this will get basically replace the single side staking ALCX pool that we have, and it will get a certain percentage of emissions just auto compounded into it. And then this will become the cross-chain version of ALCX. So if you're on Phantom, if you're on somewhere else, you'll be getting this. So ALCX will always, you won't be getting diluted by holding ALCX on another chain. And so that timeline is actually soon TM. Not sure exactly when we're going to launch it, but a lot of the work for it has already been done. Just need to get the timing and everything right for it, and UIs and stuff. But that's going to become a building block for Alchemix DAO. And we're taking some inspiration from the V tokenomics systems. We have our own unique twists on them, and I can talk about them a little bit more. But the idea is that you don't put ALCX into the V tokenomics system, but you would put this XALCX in there. So while you're in there, you're still going to be safe from dilution, essentially.
Productive assets. I like the sound of that.
Yes. So even if you lock it up for 4 years, you're going to be
Oh, will there be locking?
Yeah, it looks like we're opting for locking just because of the incentive alignment that happens along with it. Somebody becomes much more long-term oriented, and they're definitely not going to do anything stupid or malicious to the protocol if they have to be there to suffer the consequences. There's also going to be so some of this might change, so take it with a little bit of a grain of salt. We want to do those V tokens as a tokenized NFT position, much like the Andre solidly V33 thing, because if somebody does want to get out, there can be an OTC market for them to get out. Because I don't like the idea of keeping someone a prisoner. That's one of my main complaints about VCurve. Is that I locked my VCurve for 4 years, and I'm just I regret my regrets.
Tell us more about Toke. What's the plan?
So we are also in heavy accumulation of Toke. We added Toke bonds in ALCX using TALCX as the payout asset. So that's kind of an innovation. We're experimenting with that and seeing how that goes. Because it turns those idle rewards that are just sitting in the Olympus Pro Treasury contract into productive assets. We're up there with Olympus DAO as far as being top Toke holders at this point.
Oh, really?
Yeah. We're closing in on 130,000 Toke, and we're acquiring around 6,000 or so a week.
Let the Toke wars begin.
Yes. Yes. And we also did a big deposit of the Treasury's ALCX into Tokemak as well. So between those three things, and also having a bunch of Toke from doing a token swap with them, we're sitting pretty in that ecosystem.
So you've probably got some inside information from Toke about how it's all going to work in the future. Is there anything which you can kind of talk about with your integrations and how you see that playing out?
Yeah, so one of the things, and they've talked about this and it's kind of integrated into there, is that they launched their pro mode first, or just recently, and they're going to start spinning up those pools and sending liquidity out soon. And the idea for that is there's 4 different pools you can select from for each protocol right now. So it's Curve, Balancer, Sushi, and Uniswap. And so what you basically do is you vote to distribute that liquidity or to direct that liquidity to different AMMs. So right now it says that one Toke can direct around $300 worth of liquidity. And considering Toke is around $30, I mean, that's kind of a 10x multiplier on how much liquidity you can
crazy.
Get using Toke. And one of the cool things is they have that curve pool, and that's a asset and then T asset curve pool. So FXS, TFXS, ALCX, TALCX. And the idea is what if a Sushi or Uniswap or Balancer pools, or all of them have more than enough liquidity, but there's still more assets that can be deployed by Tokemak, right? They can then kind of select those idle funds and put those into the curve pair with them. And then that gives easy access in and out for T token holders to swap in and out of. And it also, allows you to like not deploy too much liquidity. Because, if you have like a token with like $100 million market cap, and then there's $80 million liquidity in the pool, that's too much relative to the market cap. All right. Like token movements in there are going to have very little effect because of the amount of liquidity. There seems to be like a sweet spot where, enough liquidity that can handle, people buying and selling at a regular basis, but not too much that would dampen, an actual bullish, price action.
Yeah, at least just from observing the way that like Olympus's kind of ratio has sat like historically, I think it's always been around the sweet spot of like 10 to 15% kind of like liquidity to market cap ratio, which seems to kind of like fluctuate in between there. Yeah, so I guess for people who haven't heard maybe people don't know exactly what Tokemak is, but it's like essentially trying to like turn a market making firm into like a decentralized market maker where people kind of benefit from coordinating, right? Because it's like paid out in having different pools balanced. So very interesting to see that kick off.
Everything is like unbundling and like rebundling, and this is just unbundling like the steps in sort of
instead of like you having to get half LP on one side, then half on the other, then stick it into an AMM. You just put in single side, and then the liquidity directors will take care of the rest.
It's a bit like it's kind of like having like a deconstructed coffee or iced coffee or something.
It's very similar, I think, in effect to essentially the curve wars and stuff like that, where people are acquiring V curve and CVX tokens, so they can direct the gauges to get their stablecoin pools, liquidity and stuff like that. I think the same thing dynamic is going to happen with Tokemak, but it's going to be generalized across DeFi, not just limited to curve. And even they've been teasing this thing called membrane. And that is apparently going to connect to sexes as well. So
centralized exchanges for the
yes,
centralized exchanges. Sorry,
yeah, that definitely could have been misinterpreted. That's all right.
Can we talk more about the DAO?
Yeah, so the DAO. So we'll have like the V tokenomic model. We're going to have some more quality of life improvements, like a rage quit thing where you can get out early by taking a penalty, being able to trade it as an NFT. And then also there's going to be some gauges. And Alchemix is a bit unique compared to some other places because we have some, I think, features that only we have. For example, the boosted yield. So like right now, the Yearn DAI rate is like 3%. But if you go to Alchemix, you'll see that we're getting 7% APY on DAI deposits. And that's because our peg stability module, the Transmuter, is also farming in Yearn. And it can then boost the yield of the users in Alchemix.
Ah, very cool.
Yeah, so we have this boosted yield because our peg stability module has like a cool 200 million DAI in it. So one thing that we're going to do is have a gauge that can direct where that boosted yield goes to. So it could be, USDC Yearn, or it could be Aave, DAI or something like that. That people can say, hey, we want to, have the boosted yield go to here, and that'll be like a gauge. And that's cool because if a yield aggregator gets in there and they want to drive more people to their platform, because if somebody chooses that strategy in Alchemix, then that becomes their TVL essentially. So that would give them incentive to have ALCX and lock it so they could direct the rewards to the people who use their platform on Alchemix. So the other one is, and this can lead into something else soon, is the idea, is Alchemix is going to branch out and have more AL assets. BTC is one that we're looking at. And for the OMIs, yes, we are looking at ALOM. And there's even a working group with members from OM and Alchemix plotting together, working on it right now.
Yeah, I have to be delicate.
Yes. And that would be where you would deposit OM or GOM, and then you could borrow ALOM off of it. So you can go long without fear of liquidation. You can sell without selling.
Yeah, you'd have to be very careful about the collateralization ratio, I think.
90%. No. 90% LTV. Go for it. Oh, degens, no. No. There's definitely some issues and some challenges in getting ALOM because the APY is just so high that the opportunity cost for liquidity providers in the ALOM pair would it would be hard to find those type of people just because they'd be giving up their 1,700 APY in GO. So doing something in tandem with Olympus DAO and our own incentives and also bonding through Olympus Pro and stuff like that, I think we can get a decent amount of liquidity added into it, enough to support it and keep the flywheel running. And if since the Alchemix, we do take the only protocol fee we take is when yield harvests are done that repay your debt. We take 10% of that. But because the OHM APY is so high, we would be able to get a lot going to the treasury because of that. And then the treasury then can become another actor or liquidity provider for our OHM as well.
Yeah, you would not need very long to get quite deep liquidity. Is that something you guys think about a lot? How much should you keep as treasury backing or protocol control value versus what is sort of returned in those fees to your governance token holders?
Well, we've done some math and we want to target 10% APR for, deposits in general, and we're kind of at the mercy of the markets and stuff like that. But that's going to inform us in which assets we choose in the future for, Alchemix when it starts coming out. For example, ETH becomes actually very, very attractive because once the merge happens and all that MEV stuff is accruing to validator nodes instead of miners, there is estimating that the ETH2 staking APY is going to be around 10%. So that's perfect for us. So right now, the protocol has around 800 ETH worth of ALETH LP tokens. And the ALETH supply is very large compared to that. But the ALETH debt cap is actually not that big compared to the amount of protocol-owned liquidity. So the debt cap applies to how much you can borrow from Alchemix. But if someone repays their debt using the collateral token, it brings down it essentially allows that ALUSD to still exist, but also brings down the debt cap, if that makes sense. So that's why even though ALUSD has a debt cap of 150 million, there's around a 300 million supply of ALUSD. It's because of that. And I think as long as we can get that ratio between debt cap and protocol-owned liquidity at a healthy level, then it's fine. So there's another thing that we're going to do, and this is in response to systems like Convex popping up. And the curve wars, they've more or less kind of become the Convex wars because all of the action, or most of the action around bribing, is bribing CVX holders and not V-curve holders. And as a result, a lot of the token value accrual is going to CVX over curve. And so V-curve citizens have become second-class citizens in their own ecosystem when they should be first-class citizens. I mean, I don't think the V-curve holders are too angry because Convex definitely has helped with curve's price, I would say. But the whole idea around, bribes and stuff like that, if there are gauges, or an opportunity for bribes, they will happen, is kind of my belief. And if we have locked tokens, like we're planning to do, then that invites somebody to come in and make a wrapper and make them tradable and stuff. And we're hoping that having an early exit like rage quit function and having them be NFTs mitigates that or prevents that from happening. But if it doesn't, there's another system we have that's going to be built into the DAO called the shard system. And the idea is that you would, when you're in the staking your V tokens, you'd start earning a secondary token in the DAO called shards. And these shards, can then be claimed. And then if you want to vote, boost your votes on the gauges, you can burn these shard tokens to add votes to whatever gauge you want to vote for. So it becomes like a liquid token bribing.
Oh, so those are tradable, the shards?
Yes, those would be tradable.
As NFTs, or are they...
Nope, no, they would just be ERC20 tokens. It would be, freely tradable. So if there does end up being a bribe market for ALCX, and the gauges and stuff like that, then our users can profit off of it.
Yeah, definitely. Okay, that's super cool. Yeah, like Alchemix is like the top of the stack, and then Ohm's trying to be like the very bottom of the stack, like out of everything.
Let's make a DeFi sandwich together, guys.
Ohm just wants to absorb everything, and then Alchemix can just sort of build on top.
Ohm is going to get a lot. I think when Ohm comes out, it's going to be very good for Ohm because it's going to give like a very safe leverage strategy for the people who are craving leverage. And it's also going to be good for Alchemix because the high APR and the interest around it is going to bring a lot of people to our protocol. And also it's going to be profitable from day one, essentially.
Yeah. And then you become a big geom holder as well.
Yep. We can put assets in the geom and also have some of the incoming payments go into protocol liquidity as well. So, we can bolster our pools and also, farm geom and then use some of those geom to then add to our liquidity pools as well. So there's lots of cool stuff we can do.
I mean, have we talked about the incurred debt feature?
I know about it some. I know about it. And once we have enough geom, we'll definitely be barking at you, at your door. give us free Ohm.
Yes.
Are you guys going to do some AMOs?
Oh yeah, I was scraping the Discord actually for this, and I did find a little alpha leak from one of your core team members.
Yes, we are going to do an AMO.
Is this an alpha leak?
Yeah, I haven't published the proposal yet. Still working on ironing out, and editing it, making it sure it's like perfect and stuff. But we've already begun development on it. So it might actually be out in time for V2. Hopefully, fingers crossed. If not, then shortly after. The AMO is going to be an extension to the Transmuter. So right now, the way Alchemix V2 works is that there's like the Alchemist contract that does the CDPs. And then there's the Transmuter contract, which handles the peg stability modules. And then there's like an in-between called the Transmuter buffer. And this will hold funds and keep them productive. And then it'll send some money to the Transmuter so that people can exchange assets and stuff like that if they so want to, or there's a need to do it. But instead of having the funds in the Transmuter buffer just go into Yearn or some other strategy, we're actually going to create an algorithmic market operator similar to what Frax does. And like right now we have 200 million DAI and 80,000 ETH in our Transmuter peg stability modules. And the plan is to dump it all into our relevant curve pools. Like, it gives us really awesome peg controls because in Curve, you can withdraw single-sided from one side and deposit single-sided. So if for any reason the pool ever gets out of balance, we can just withdraw ALUSD single-sided. And it's almost like the same effect as if someone's using the Transmuter to try to arb the peg and stuff like that. We can just take, that discount away. And then we'll have ALUSD like sitting idly that can then be deployed to other things like Tokemak or Rarefuse and other places like that to keep it productive. And if the peg is still hurting, even in the secondary strategies, we can just kind of like remove it from the secondary strategies and get it off the market altogether. And it gives us that ability. We can't mint our token into it like Frax can, but we do have some of these really advanced peg controls, and it will allow us to then put our full weight into convex. So like Frax, like you see that they bribe like $7-8 million every single week on their Frax 3 curve pool. But since they own more than half of the liquidity of that pool, and they have a crap ton of CVX tokens that they vote with, effectively they're profitable spending that much every 2 weeks on bribes. Because there's a multiplier on the convex bribes, so you get, if you put in like $100, you're going to get more than $100 in rewards back for that pool. So there's that. And if you vote on your own pool that you also add bribes to, you get that token back. So it's like a rebate on your bribes. And by doing this, and having like close to half of the liquidity in the pool, and imagine there's a 2x multiplier, that already makes our bribes neutral as far as cost of the protocol goes. And then when you're taking into account the rebates we get for voting for our pools, because we have a decent amount of CVX, it actually becomes profitable at that point. And so what we would do is just hoard all of the CVX and lock it in and get it into a flywheel compounding loop. And then with the curve, probably lock some of it into CVX curve. And then the rest would probably melt it down for boosted yield for our users so that, we can have higher yields than our base strategies that we hook into.
So it's kind of does that all algorithmically.
Yes. If price is under 99.8 cents, withdraw ALUSD single side and then be idle waiting to be deployed into a secondary strategy. And most of it would be done by keepers, and there might be some governance built into as well as far as directing the liquidity to other protocols.
So my understanding is that like if Frax is in the pool with you, then they will kind of be doing that themselves through their AMO as well. Is that?
Yeah. Imagine a Frax Alchemix AMO when we add Frax.
Yeah.
We can put Frax into Alchemix, borrow ALUSD, put it into the D3 pool, then mint some Frax into the D3 pool to balance it versus ALUSD.
So D3 is ALUSD, Fey, and
no,
Frax?
That's on curve. Yeah, it's saddle, Frax, and LUSD. And D4 is on saddle, and that also has LUSD in it.
All right. So is D3 so Fey and you guys are already in the curve wars, but that becomes like the sort of de facto. I saw Sam like posting about this on Twitter about DAI having this super privileged position where they don't have to spend anything to like keep their peg very tight because
they were included in the 3 curve.
Yeah, exactly. So are you going to what is kind of your opinion about like DAI and UST and USDC? Like you guys don't really have anything to do with USDC other than your like 3 curve owl pool?
Well, it will be a collateral type in V2. So,
for the yearn vaults. Yeah.
Yes, for the vaults, yes. USDC will be a collateral type. But I do agree with that sentiment. That is why we formed D3. Because like when you're in a 3 pool, like MetaCurve pool, you're not only incentivizing your side, but you're also incentivizing USDC, USDT, and DAI liquidity as well. And that gives, Circle, Tether, and MakerDAO a free ride. And that's why, us, Fey and Frax joined together to make D3, because instead of us having to pay, one protocol having to pay 100% for the pool, each protocol now has to pay 33%. And that's a lot more economical. Like we spend a fraction on D3 that we spend on our 3 curve pool. And it's already gotten over 100 million liquidity total in that pool, and it's going to be growing because Fey is adding more bribes now, and Frax is getting more aggressive, and we're part of this AMO strategy is that we're still going to get emissions directed to bribes, but then the bribe rebates that we get are going to be rolled back into the next week, so it's going to be growing and growing and growing. So because of that, that's in the face of disinflationary rewards, mind you. So it's exciting. I'm an Alchemix permeable, as any founder should be of their own token. But now I'm like one step above that with this AMO being introduced.
Yeah, they're super, super cool. Are you looking to do like another, like they've released these Curve V2 pools just now for sort of a 2-sided pool?
I've been playing with the Desmos formula for it and trying to plot out some different curves and things like that. And I've kind of floated it to, like the team and also to the Discord. about it, but nobody really picked up on it. I might start, trying to, talk about it some more. I definitely think it makes a lot of sense to do that and get onto Curve. We just have to familiarize ourselves with how the V2 pools work and kind of custom tailor our curve pool, or like our actual curve on the line to, be what we want it to be. And that's going to require some research to make sure that we get that right.
Definitely seems like you're heading down the right track, though. I mean, the amount of alpha in the last 15 minutes.
Yeah.
Crazy.
Yeah. So, and our price is pretty depressed right now. Wink, wink.
I know people come on the podcast and then the founders tell us, and then you're like, oh, this is actually super undervalued. I sometimes just go and I'm like, oh, I got to go buy some more. Are you still keeping a uni or a sushi pool as well?
This would all have to be up to governance, really, about what we do and stuff like that. So we're going to engage and talk more. We're building out a sub-DAO in Alchemix that's going to be focused directly on governance and business development. I'm trying to decentralize my role a little bit more because me doing this by myself is just untenable. So now we're going to have a team. So we're trying to get people to kind of, start doing their own autonomous business development and stuff like that through a sub-DAO where they'll, have an ALCX budget and stuff like that they can pay themselves with and then use the rest for deals and stuff.
It's exciting. I think the kind of siloed autonomy way of working within DAOs is it's kind of siloed departments, but central communication, I think, is the way to go as DAOs expand. Using some kind of whether it's a Notion or whether it's some other kind of tooling, but kind of having that all set up properly and then having all the departments kind of be in their own little bubbles seems to be the...
We have a weekly sync with our team. We're on 4 different continents, so, we can't do daily syncs unless, it's going to drive one person insane. But what we're doing is we have a newsletter group and we have a sub-DAO that's forming, and the leaders of both of those groups join our weekly sync so they can be in touch with what's going on in core and stuff.
Yeah, we love the newsletter.
We do. I love the newsletter.
We're biased.
I mean, we love a good community newsletter, and I can't help but laugh every time I see a new cover. Very, very creative. But before we kind of wrap things up and plug, since you guys were OP pilots, I want to pilot this new little thing that we do at the end of each podcast, where it's I essentially say a word and then you give a corresponding word as an answer. So it could be NFTs, and then you'll say a one-word answer or brief kind of answer. And we'll do a quick rapid fire, or just kind of zoom through a couple.
All right.
Let's go.
I'll try not to be a word cell here. Right. Okay.
No. Okay. NFTs.
Absurd.
Bonds.
Good.
Liquidity.
Important.
Alchemix.
The best.
Olympus.
Dope.
V2.
Soon.
DeFi 2.0.
Not a meme.
Community.
Comes first.
All right. That's it. That's all we need to know. That little segment's no attention span, no problem. So we're going to start doing that every single interview we have. I think that'd be fun.
Yeah, it was a pleasure to be on here with you guys. It was a lot of fun.
All right. What are we shilling?
Okay, yeah, so you can learn more about Alchemix at alchemix.fi, or you can find us on Twitter at Alchemix V2, one word. And then, if you guys want to know what's going on and get the heartbeat of the community, join our Discord. We're a very friendly bunch, and there's lots of people in the community, and devs included, that will be there to help support you if you have any questions and want to learn more.
And your Twitter handle is at Scoopy, SCUPY, Trooples, TROOPLES. This has been super fun. Thanks for coming on.
Yeah, likewise.
Bye.